Ever wondered what accountants mean when they talk about equity? It's a word you'll hear a lot in business, finance, and even in the news, but it can sound a bit mysterious if you're not used to accounting lingo. Let's break it down together in plain English so you can finally get what's going on behind those balance sheets. Whether you're a business owner, a student, or just curious, understanding equity is a key step in making sense of how companies work. Equity in accounting is pretty much the value of ownership in a business. It's the part of the company that actually belongs to the owners, after all the bills and debts are paid. It's what's left of the company's assets once you subtract all the debts and liabilities. Think of it as the net worth of the business from the owner's perspective. Or in other words, equity is what you actually own after what you owe is paid off. If you sold everything the business owns and paid off every debt, the money left over would be your equity. Let's take a simple example. Imagine you start a small bakery. You've always dreamed of sharing your favorite recipes with the world, so you decide to turn your passion into a business. You put in $10,000 of your own money, buy equipment, stock up on flour and sugar, and get things rolling. That initial investment is what gets your business off the ground. That $10,000 you invested, that's your equity. It represents your stake in the bakery, the part that's truly yours. As your bakery grows, you make profits. That's great. Maybe you use some of those profits to buy better equipment or expand your menu. All of this adds to the value of your business, and your equity can grow as a result. Maybe you borrow $5,000 from a friend to buy a bigger oven. Now, your bakery's total assets might be worth $20,000, but you owe $5,000. Loans can help your business grow, but they also add to your liabilities. Your equity? That's $20,000 minus $5,000. So your equity is $15,000. It's a simple calculation, but it tells you a lot about your financial position. In accounting, you'll see equity appear on the balance sheet. The balance sheet is one of the main financial statements, and it gives a snapshot of what a business owns, owes, and what's left for the owners. The classic formula is assets minus liabilities equals equity. This formula is at the heart of accounting, and it helps everyone, from business owners to investors, understand a company's financial health, or just AL = E. It's a simple equation, but it's incredibly powerful for understanding how businesses work. This is called the accounting equation, and it's the backbone of every balance sheet you'll ever see. No matter how big or small the business, this equation always holds true. But equity isn't just one thing. It can take different forms depending on the type of business and how it's structured. For companies, equity can include things like common stock, retained earnings, and even additional paid-in capital. These are all ways that owners and investors can have a claim on the company's value. For sole proprietors, like our bakery example, it might just be called owner's equity. This is the simplest form where one person owns and controls the business. For partnerships, it's called partner's equity. Each partner has their own share, and the equity is divided according to the partnership agreement. Why does equity matter? Well, it tells you how much of the business the owners truly own. It's a measure of their stake, and it can change as the business grows or takes on more debt. If you're an investor, equity shows you the net worth of the company. It's a key number to look at when deciding whether to invest or not. And if you're running a business, watching your equity grow over time means you're building value. It's a sign that your hard work is paying off, and your business is becoming more valuable. So next time you see equity on a balance sheet, remember, it's not just an accounting term. It's the piece of the pie that actually belongs to you, or the owners. It's your reward for taking the risk and building something valuable. Keep that in mind as you dive deeper into accounting. Understanding equity will help you make smarter decisions, whether you're running a business, investing, or just trying to get a handle on your finances. Thanks for watching. Don't forget to subscribe for more quick accounting guides. Stay curious and keep learning.